Hey everyone, Bill Lethman here with Money Evolution. In today's video, I'm going to be talking about how to pay the taxes on your Roth conversion. So if you've been on the YouTube channel here, you know that Roth conversions are one of our more popular topics here, but also one of the biggest questions that I get asked all the time is, how do I actually pay the taxes on the Roth conversion? What are some of my different options? But real quick though, before I get into today's topic, if you want to learn more about what we do at Money Evolution, we've got some links right below the video here. If you want to learn more about our comprehensive financial planning called Wealth Vision, we've got some links for that. Also, our retirement planning course called the Retirement Time Machine, and some great free resources there as well. Okay, so first it's important to understand how exactly Roth conversion income is taxed. Now, there's a lot of different ways that our income can be taxed. In fact, I actually made a video here recently where I talked about 7 key tax rates on how all these different sources of income are taxed essentially at different tax rates and have different rules that apply to them. But your Roth conversion income is going to be taxed at what we call your ordinary income tax rate. We also call that your income tax base or your marginal tax bracket. So the easiest way to kind of understand that is if you are familiar with a tax table, any Roth conversion income that you get is going to be added to that income tax table at whatever marginal tax bracket that you may be in for the year. So for that, it's important to know what tax bracket you're actually in. So for example, if you're married filing a joint tax return and you're trying to target, let's say, the 24% tax bracket, something we've talked about in other videos as sort of the sweet spot for Roth conversions, then in 2023, you can have $364,200 of income tax base income, which of course that Roth conversion amount is going to be a part of before you go up into that next tax bracket. So it's very important to understand where you fall within your tax bracket. And as we always talk about with Roth conversions, always important to kind of have some forecasts of where you think some of those future tax rates may be. And really, conversions only make sense if you're thinking that you're going to be in a lower income tax bracket today than what we think that might be out into the future. Okay, so let's continue on with that example. Married filing joint, trying to target the 24% tax bracket. Let's say that you determine through some calculations that converting $100,000 from your traditional IRA account to your Roth IRA account is the number that makes the most sense for you. So again, you're in the 24% tax bracket. So if you're converting $100,000, you're going to owe $24,000 in federal income taxes as a result of that conversion. Let's also assume that you're in a 6% state income tax rate, just to kind of keep our math super easy. So obviously 24 plus 6 puts you up in the 30% combined state and federal income tax bracket. Again, your state tax may be different. There's a lot of states that don't have any taxes, but let's just kind of go with this and figure what are some of the things we need to be thinking about as we're talking about paying our taxes. So what we know using this example is that you're going to end up owing $24,000 to the federal government for your IRS taxes, and then an additional $6,000 to the state government for your state taxes, totaling $30,000. Now, one of the most important things to understand before doing any Roth conversion is where are you going to get the money to pay those taxes? Where's that $30,000 going to come from? Now, ideally, that money is going to come from some assets that you have in non-retirement accounts. If you remember back to some of our other videos where we talk about the 3 tax buckets, we have non-retirement accounts, we have traditional retirement accounts, and we have Roth retirement accounts. So that non-retirement account bucket is ideally where you're going to get the money to pay the taxes. But it's also very important to understand what that money is invested in or if it's invested at all. So ideally, that money is maybe sitting in cash and you've already pre-planned for some of this tax money that you're going to have to pay, and you'll be able to use that money that you have in savings or money market accounts to pay the taxes that you're going to owe on this conversion. But in some situations, you may have that money invested. You may have to sell something in order to get the money that you need to pay the taxes. And it's going to be very important to understand that some of that is going to influence some other aspects of your taxes. So for example, if you have to sell stocks or mutual funds, it may be that those are being sold at a capital gain. And then it's important to also note that it could be a long-term capital gain or it could be a short-term capital gain. So long-term capital gains, as we've talked about in other videos, get taxed as a preferential tax item and are not actually part of the income tax base. So in other words, even if you had $100,000 in long-term capital gains, that's still not going to be part of what's going to push you up into that next tax bracket. But if you have short-term capital gains, that is something that's going to be added to your income tax base. And you want to be very careful about that those sales of investments that are going to maybe be short-term capital gains don't actually push you over into that next tax bracket, meaning that you'll pay more than 24% on a part of your income. Also, look at interest income. So if you're getting any interest from CDs or bonds, those are other things that are going to be taxed at your income tax base rate and can also push you up into the next tax bracket. So ideally, you've got some assets that you can use in those non-retirement accounts to pay for the taxes on your Roth conversion. But what if you don't? What if you don't have the assets to pay for the taxes on the conversion? Should you still do it? Does it even still make sense? Now, my answer to that is still typically yes, because again, the biggest determining factor for doing a Roth conversion is what is my tax bracket today versus what do I think my tax bracket is going to be in the future? And if that tax bracket today is less than what we think it's going to be in the future, then we should still think about doing that Roth conversion. But we're also going to have to adjust and account for the taxes a little bit differently. So let's go back to our earlier example where we're trying to convert $100,000 from our traditional IRA account to our Roth and still stay under that 24% tax bracket. So assuming that 100,000 is pushing us right up until the top of that bracket, if we take any more money out, let's say for the taxes, then we're going to be pushed up into the next tax bracket. That's probably not what we want. So if we want to do this the correct way and that 100,000 is going to push us right up to the edge, then what we'll do is a $70,000 Roth conversion, but then at the same time take a $30,000 distribution from our retirement account. And that $30,000 is then going to be used to pay the taxes on the conversion, and then you'll have $70,000 in your Roth IRA account. So again, not quite as ideal as if you were able to use some of your non-retirement account assets to pay for the taxes, but still a pretty good deal when usually we run this through some of our financial planning tools. Now, one very important thing to know if you're thinking about doing this, if you're under 59 and a half and you're thinking about using your IRA money to pay for the taxes on your Roth conversion, you're going to end up in a situation where you're going to owe that 10% penalty in addition to the taxes on the conversion and the taxes on the withdrawal. So obviously not a very ideal situation, probably not something that still even makes sense. But if you're over 59 and a half, this is definitely a strategy that you can do and use some of that IRA money to pay for the taxes on the Roth conversion. So just because you don't have the money set aside in those non-retirement accounts to pay the taxes on your Roth conversion doesn't mean that you should rule out the idea altogether of doing those Roth conversions. Again, as long as you're over 59 and a half, you can actually take the money for the taxes out of the IRA account itself and just roll over a smaller amount to your Roth IRA account. And the numbers, I think, generally still look pretty good. So that covers how to pay the taxes. Now I want to talk about when to pay the taxes. And I think it's this topic that creates more questions and more confusion and oftentimes leads to mistakes when it relates to doing Roth conversions. And that's because the IRS has some very specific rules as to when you're supposed to make estimated tax payments for any income that you earn throughout the year. So for example, if you do a Roth conversion in the first quarter of the year, you're going to need to make an estimated tax payment before April 15th of that year. A lot of times people think that they can wait all the way until April 15th of the following year. But if you do, you're likely going to end up in what's called an underpayment situation and get a penalty for that. If you do a Roth conversion or have income in the second quarter of the year, you have until June 15th to make that estimated tax payment. If you do a Roth conversion in the third quarter, you have until September 15th. And if you do a Roth conversion in the fourth quarter, you have until January 15th of the following year. And you're going to want to make these estimated tax payments on Form 1040 ES. Another very important thing to think about is if you live in a state that does have state income tax, like we've been using in our example, that 6% tax, you're going to also want to make sure that you do an estimated tax payment to your state as well, because you could end up in an underpayment penalty situation there as well. So very important to pay that tax in the quarter that you earn that or that you have that Roth conversion, not wait until April 15th of the following year. So one last thing as it relates to paying the taxes on your Roth conversion are what are some of the other consequences that your conversion could have on other aspects of your financial picture. One of those things I think is going to be healthcare. So if you're not yet on Medicare, you're under 65 years old, you may be going out into the exchanges to get your healthcare. And it could be that you're getting a subsidy for your healthcare depending on what level of income you're going to be at. So one thing to think about if you're going to be doing a Roth conversion, that income is going to be considered for purposes purposes of getting that ACA subsidy. And it may push you into a level where you don't get that subsidy any longer. So something definitely to think about. Now, it doesn't necessarily mean that you should not do the Roth conversion, but you want to understand what are some of those trade-offs. What is the long-term benefit of doing that Roth conversion versus what are you maybe giving up in the short term to pay a little bit higher, or maybe sometimes even a lot higher in medical health premiums. The same goes too for those of you that are on Medicare. So if you're 65 years or older, something called the IRMA kicks in, and that means that if your income is over certain thresholds, you'll pay more of a premium for your Medicare. And so even though you may still have room left in your tax bracket, it could be that above certain levels, you could be paying more, and sometimes even substantially more for your Medicare costs. So that, again, that's something else to think about, and it doesn't necessarily mean that you shouldn't do the Roth conversion, but also, really understand, what are some of the trade-offs there between paying those higher Medicare costs or getting a long-term benefit of the Roth conversion. So there you have it. We took a deep dive on how to pay the taxes on your Roth conversion. Hope you got some great information out of it. If you do like the video, be sure to hit that like or subscribe button. Also, be sure to check out some of the links below. We talked about our Wealth Vision financial plan, the Retirement Time Machine course, and some links to some great free resources that we have up on our website. So check those out, and I'll see you back in our next video.